We're very fortunate today to have both ASIC and APRA here, who will give us a fulsome discussion about emerging and ongoing issues. Our first speaker today will be Craig Roodt from APRA. Craig is Head of Investment Risk and leads a number of review teams. Craig has been instrumental in APRA's policy development, particularly in regards to SPS 530 and various investment-related prudential practice guides. This morning, Craig will be speaking about investment strategy and particularly APRA's expectation that investment strategies should be set in the best interests of all members. He will then be discussing various aspects of insourcing and outsourcing and what issues are arising for APRA in respect to those various requirements. Our second speaker is Greg Tanzer from ASIC. Greg is a ASIC Commissioner and previously was the Secretary General of the International Organisation of Securities Commissions. Greg will be discussing corporate culture and its impact on investors, and also we'll be discussing various aspects of RG97, particularly in the face of the looming due date. Questions will be taken after both speakers have completed, but in the interim, if you could send your questions through on the AXA Q&A, that would be fantastic. So I'd like to welcome Craig Roodt to the podium.
Thank you, Paul, and thank you all for having me here. It's great to be here with all of you, especially, and a big thank you to all of you for actually coming back on day 3 at 9 a.m. I was told I sort of drew the short straw, but I can see that's not the case, although I hear the dinner was great last night. So I'll just speak briefly about a couple of issues on our radar. The interesting thing was that as I looked at I was asked initially, the title was what's on our radar, and I was thinking, for a regulator, it's a little bit like, an air traffic controller. An air traffic controller has so many things sitting on its radar, and it's got to, part of their job is to decide on what to look at. And interestingly, one of the things I'm going to mention today is data and the data challenge. And of course, data is highly critical, data is really important, but one of the challenges of data is it actually gives you even more things to think about. And some of the questions we've been raising have actually been founded on the fact we now have better data and better information, just the same as, satellite observation gives more information. So of the various blips on the radar, I'm only going to talk about two. One is this question of, strategies need to be set in the best interest, or need to be set in the interests of members and in the interests of the membership. And it's important that we're talking about the membership as a group. We're not talking about individual members, because trustees can't, as a general proposition, trustees can't reasonably know what each individual member needs. That's not reasonable, and it's not what they can do. Trustees are responsible for what they offer and what they provide. And then we'll talk about the in-housing of investment management activities. Now, I have a few slides here. I'm actually not going to talk to every single slide, and looking at them this morning, I may not even follow the exact order of them, so I do apologise for that. I'm not breaching the strategy. I've just decided I've had to adapt the strategy based on the circumstances. So think of it as a dynamic presentation. All right, so now, one of the challenges with superannuation is it's very distinct from the other industries we regulate. And the distinction is that the other industries we regulate are based on a contractual promise. So our mission at APRA is to make sure financial promises are kept. Well, with banking and insurance, that's actually conceptually pretty simple. It's a promise, right? The bank has to give you your money when you ask for it. An insurer gives you your money based on certain contractual conditions. And that's an oversimplification. Of course, as we all know with superannuation, and especially with DC superannuation, it's a fiduciary promise. So this is more about process, governance, making sure there's a proper basis for decisions that are made. And of course, the clear outcome of that is that with superannuation, like with investment management, there are very few absolutes. So one of the things is, unfortunately, I'm not able to come here and provide a whole lot of answers of here's the checklist that will actually show that you actually met member needs. What we do is we raise a whole lot of questions. And in that process, a series of questions need to be asked. And the first thing is about working out, well, what are member needs? And it's going to vary based on the type of product. So ultimately, if we think of investment management as ultimately being about meeting member needs, about meeting objectives, and then deciding which investment risks to take in terms of meeting those objectives, normally most of our time at APRA is spent more thinking about that second one. How was that done? But the actual setting of the objectives is critical. Now, if we look at sort of the history, if we look at the history of superannuation in this country, and you can argue it's 20 or 25 or 30 years, it's been mostly about running accumulation engines, and there's now an evolution in trying to develop, if you like, retirement income products, as in building portfolios that will be able to generate enough of a portfolio to provide income in retirement, and from that feeding back and determining on the sort of target allocation that's needed. So it's really about trying to understand enough about the membership, and this is an evolving area, but it's about understanding enough of the membership to understand what sorts of return profile is needed to try and achieve the objective that's been set, what's an appropriate objective to set, and then from that it becomes almost a technical problem. So once the actual target has been set and the objectives have been set, it becomes a technical problem of how to meet it. But an important component of that is also what happens when things don't go as planned, which is really about dealing with the downside and dealing with the risks. And a lot of that comes back to what are member expectations. Now I'll just move on. Okay, so one of the issues we've touched on is the product type. So a lot of the issues around trying to, if you like, harvest demographic information, psychographic information on members, that's actually going to be more operative in the MySuper space towards the left. Because MySuper is really about, as I use the analogy of mixing up the soup for the member, you've got to try and determine, based on what you know of the member, what do they need? That's the key. Difficult to do. We're not pretending it's easy, but what we also need to see then is a process that takes that espoused need or espoused understanding, and how does that actually translate into an investment allocation? So as an example, investment beliefs are critical, but strategy shouldn't be based, the investment belief informs the strategy, but the investment strategy shouldn't be built because there's a belief there. And what I mean by that is, as an example, if you believe that, if you wanted the cheapest asset allocation possible, you'd put all the money in cash. And if that was your investment belief, that's what you do, but that wouldn't fit with what members needed. And so what we're talking about here is, it's looking at what does the membership need and trying to build a strategy based on that. When we get into the choice products, there's less of a challenge purely from the point of view of people are self-selecting into those. And so it's really more about, okay, have you sold what you described? And importantly though, does it behave in the way you would describe? And I'll come back onto what that might mean in a moment. I've spoken about data. All right. This graph was put up at the Banking and Wealth Summit back in April, which actually generated a lot of the questions of what APRA is looking for. This is the graph is meant to show that, so what the question that got posed at the Banking and Wealth Summit is the fact that if we take the data, and again, APRA is dealing with the data challenge, one of the things is we previously focused, if you like, entity by entity. We are increasingly able to pull up data like this, and don't focus too much on the dots, but we're increasingly able to pull up data like this and say, well, this is what we see across the industry. How does your entity compare? So it doesn't mean this is what your entity has to do, but it does inform that. What this graph shows, for example, is that we have funds with the same allocation to growth assets, and some of those have a target return of 6% and some have a target return of 2%. Now, accepting there are differences between what does growth actually mean and that there's a lot of information underneath the data, that does raise some obvious questions in our minds. And more important though than the fact that we think it's a question, what's important for funds is that they ask themselves the question. If I've got the same growth allocation as, I'll say, every other fund, but I'm only going for a target return of 2%, am I taking excessive risk to get that 2% return? Equally, if I have a similar asset allocation to everyone else, do I think I'm going to get a 6% target? Do I think I'm going to get a 6% return? Well, what sort of risks am I taking to achieve that? So that's the purpose. So it's really about funds looking at where they would sit on this particular graph, for want of a better way of putting it, and then working out for themselves, does it make sense given where they are? But critically, it's about digging down into the data. As you can see, I mean, if I just throw that up and throw it at people, that's not going to mean too much, but it's really understanding what does it mean for their own fund? What does it mean in terms of where they are sitting? That's the critical thing. So it's the wide variance that raises questions from us, but again, as I've said, there can be very good reasons for that. So it's not saying if you're sitting at the bottom or at the top, you know, of that particular scatter plot that you're wrong. It's about understanding why you are sitting where you are sitting. And again, this just comes back to how's the return target been set, but critically what we look for, and again, the emphasis is on process. What's the link between the decision that's been made and the actual asset allocation that's been built, and that's actually what we look for. One of the other things that we talk about in this is, because we get a question, well, you talk about stress testing, SPS 530 calls for stress testing, what's the purpose of it? One of the things it does is it enables you to look at what happens in a bad environment, well, we know that, but the other critical thing is it lets you translate what that outcome would mean for the member. We all know superannuation is a long-term investment, but are members happy with a 30, 40, 50% retracement? And in some cases, yes, in some cases, no. The clearest application we actually see of this, interestingly, is in the fixed interest space. So we've had several funds that have actually gone away, they've done the stress testing, and what they said was, oh, you know what? Our fixed income portfolio, our defensive product, in the stressed environment, it absolutely gets smashed. And we think the product's fine most of the time, but in a stressed environment, it's still getting smashed. And our members do not go into fixed income to get bashed up when things go badly. And so that's one application as an example. It's about looking at not only what happens and what does this mean in a technical numbers investment sense, what would it mean for a member on the receiving end of that statement? And that's one possible application of stress testing. It's looking back and saying, well, what would happen if this occurred? Now, I'll just briefly touch on bringing it in-house. Fundamentally, as you know, APRA doesn't have a position on whether people bring things in-house or don't. That's their decision. That is their decision. Fundamentally, though, it's about the fact that the risk profile will change. So if you choose to bring activities in-house, necessarily, the risk profile changes. You will now be doing different activities. Now, this is actually, if you like, a stylised value chain. We used this in the article we wrote on operational due diligence a couple of years ago. So you might say, well, not every box there is going to apply to me. Well, it will depend on what you bring in-house and how you do it and how you choose to do it. But the key thing here is there are different issues. You will now have to deal with the dealing process. You need to think about what you're doing on the middle office. Does the performance attribution need to change? So there's a whole lot of things that need to change. What does it mean at board level? Does the board need different skills? So it leads to, so the key there is when we see people in-housing, it's about what's the basis for it? What's the logic behind it? You know, we once saw a fund that said, oh, well, we're going to bring in Aussie equities because you know what, you just get the data from Bloomberg and we can run a few spreadsheets and there we go. I don't know why we paid someone a fee to do this. You know, and then on top of that, they didn't run it as a project. So like any project, an in-housing program needs to have success criteria. It needs to have milestones. It needs to be managed as a project. And so there's a whole lot of, in addition to the simple investment thesis for bringing it in, there needs to be an understanding of all the issues, a holistic assessment of all of the operational issues that go with that. Will the IT system be sufficient? All of those types of things. Oops, sorry, And really what we're looking for is what's the basis for the decision, how will success be defined, really critically what resources and capabilities are present, and what's the plan to go and get those resources and capabilities, because presumably if this is an activity you've not done before, you need to go away and find the resources and activities to do that. How will you acquire them? How will you retain them? Really critical, what's the fundamental logic behind the activity? And indeed, how sustainable would that be? So if you believe, for example, that you will do it much more cheaply, where will your cost advantage come from? Or where does the cost advantage come from, and will you be able to retain that? Or is it a function of, if you as an example, if you thought the advantage would be you would pay people less, well, will they stay? And again, I'm just throwing that out as a question, for a particular situation. And of course, one really critical issue there is the cultural alignment. You're going to be bringing in presumably different people. How do they then fit with the rest of the organisation? Indeed, many of you will say, well, does that matter? If you feel it doesn't matter, how do you actually deal with that? I'll call it cultural mismatch. You're going to bring in, presumably, a significant number of people. What does it mean? What will their incentives be? And importantly, how will they be assessed? Because there is a very different decision between how you address performance issue in an outsourced manager, and how you address performance issues amongst your own staff. It doesn't mean it can't be managed, it's just a couple of extra issues. Now, I didn't actually do a proper conclusion slide, so in summary though, what we're looking for with investment strategies is a proper basis for the construction of the strategy, and understanding, attempts to try and understand what member needs would be, but equally a deep understanding of that, because again, looking at surface data, as to be fair, we have done at APRA, doesn't provide the full picture. We understand it's something that's being developed through time, and it's not an easy area. It's very difficult to know the needs of a very large, diverse group of people. Choice products, it's a bit easier because it's more about how it ties up with the product description, and people are self-selecting in. So it's a bit easier there to know that you're meeting, or to attempt to meet the member needs. But importantly, there needs to be consistency then between what's actually developed and and the initial decisions that are made. On in-housing, again, it's very much a question of a holistic assessment. What's the basis for the decision? How's the project run? And what's the plan to bring in the necessary resources and to keep those? Again, thank you very much for your time this morning, and I think at that point I'll hand over to the commish.
Yeah, thanks. Thanks very much, Craig. And thanks also again, it's a bit of a broken record obviously, but thanks to the organisers for the opportunity to speak to you all today. I've really enjoyed the last couple of days or day and a half that I've been here. There's been a lot of intellectual food for thought and a lot of good discussions going on, so hopefully you'll get a lot out of this session as well. For those of you who are suffering a little bit of withdrawal symptoms, we didn't offer you the opportunity to express your view on a particular question today. We talked about it before the session. We said, well, it probably doesn't really lend itself to that sort of question. What's your favourite regulatory topic? The best question that I could come up with was, and it might be something for you who are suffering withdrawal symptoms about not being able to vote this morning, the best question I could think of is, which regulator would you most like to have come to visit? Would it be APRA? Would it be ASIC? Would it be the ATO? Would it be all of the above? Now notice I didn't give you a none of the above option. That's what you call in legal circles a leading question. Anyway, thanks very much for the opportunity to speak today, and hopefully this will be stimulating for you. I'm primarily going to talk about three topics. First is ASIC's current focus on culture and conduct and why it should matter to you. Second is the topic that I think most people are interested in around RG 97, fees and costs disclosure for superannuation, but also for managed investment products. And thirdly, performance reporting. So look, let's start with culture. What is culture? Well, culture, it's variously defined in lots of different places, but basically culture is a set of shared values and assumptions within an organisation. It effectively reflects the underlying mindset of an organisation or of a team, the sort of unwritten rules of how things really work, how decisions get made. It works silently often in the background of an organisation to direct how an organisation and its staff think, behave, and as I say, make decisions. Because culture lies at the heart of an organisation and how people behave, it's a very important driver of the outcomes for investors and consumers. And so really culture matters to ASIC because poor culture can be a driver of poor conduct, and we regulate conduct. Bad conduct in particular can flourish, proliferate, and may even be rewarded within an organisation which has a bad culture. Good culture, on the other hand, tends to help uncover and inhibit bad conduct, and it rewards and encourages good conduct. So companies obviously should be interested in culture, not just because of avoiding the bad things happening, But there's many academic studies, from the Harvard School of Government, John F. Kennedy School, London School of Economics. A number of really excellent academic institutions have produced studies that go to show that companies that have a good culture and a sustained good culture tend to see that reflected in the bottom line. That is, having a good culture and behaving well is good for business and good for long-term shareholder value. And obviously for the organisation, that gets reflected in brand loyalty, brand recognition, customer loyalty, the reputation of your firm, helps attract and retain staff, and not least in financial services over the last sort of 5 or 6 years, it helps you avoid the sort of massive fines or remediation programs that a number of financial services organisations are dealing with right now. So why should you care? Well, firstly, certainly for the trustees in the room, you're all investors of other people's money, and culture affects the performance of the companies that you invest in. So you should worry about that, just like you worry about a range of other investment characteristics. Secondly, though, also, and this is really for everyone in the room, you should also care about your own organisation's culture and whether it generates good outcomes for your particular business, for your particular customers. As a conduct regulator, we don't seek to dictate what an organisation's culture is, and I'll come back to that in a moment. But one thing that we do say, particularly for financial services firms, is that we do consider that a positive culture is one that supports doing the right thing by customers and a focus on the long-term best interests of your customers or investors. And this should underpin every aspect of business operations and every decision of the business. So it ensures that customers come first, both when things are going well and when they're not. It ensures that financial products are designed to provide utility to a specific target market and that the right products and services get to that target market, not just to any market. It has controls in place to support that culture, and critically it has a recruitment, training and reward structure that's aligned to and reinforces the culture of doing the right thing and good outcomes for customers. And so this, obviously, there's lots of management consultants and other people who can tell you how to do this, but most leaders well understand that this needs to start from the top with a clear explanation and delineation of what the culture and values are that drives the organisation, and exemplifying that throughout the organisation, walking the talk as it were, and continuing to communicate with that and monitor how this works. So what's ASIC doing about this? So we're incorporating culture into our surveillance-based work, and we're doing that because we think that that will help us better target our surveillance on those entities where we think they're at most risk and misconduct. It'll also assist us in identifying and understanding the problems and risks in the market and the underlying drivers of systemic poor compliance or misconduct. And also, it allows us to provide feedback to firms about areas where we think their culture might be falling short. While we're explicitly looking at cultural indicators in our surveillance work, this isn't entirely new. We have always considered indicators and factors, in particular those that drive poor behaviour, because we are a conduct regulator. Unfortunately, that means that often we're looking at the dark side of this. You will often, when you're dealing with this in your organisations, you'll be looking at the more positive aspects of this, your staff engagement scores, the customer feedback, how satisfied they are. We're also very interested in some of the indicators about where things go wrong. How do you deal with staff who come to you and say, I think something's going wrong in this part of the business? How do you deal with whistleblowers? How do you breach report to us? All of those sorts of indicators as well. Now, I did want to emphasise, though, we are not seeking to regulate the culture of individual firms. We're not seeking to dictate the particular culture beyond saying it needs to be something that's focused on the long-term best interests of customers. Culture lies at the heart of how an organisation runs, and so getting somebody else to dictate it to you does not make any sense. And culture, I don't think, is something that can be regulated with black-letter law. It just doesn't work that way. But if we do identify a cultural problem, I can tell you that we will and we are making it clear to firms in which we see it. And that's been quite powerful in our discussions at boardroom level, at senior management level, and so on. So my second topic is fee and cost disclosure. It's important to note at the outset, I think, that fees and costs is one, but only one important factor that investors should be concerned about. Obviously, asset allocation, investment objective, strategy, risk, they're all very clearly important. And I will mention a little later, just in closing, some work that's coming up on performance reporting, which is also, I think, an important topic and an important thing for investors to consider. But in regard to fees and costs, we have been focused on this for quite some time. Our objective is to improve the quality of disclosure by addressing some of the issues that we've observed in the market that lead to inconsistency and under-disclosure of fees and costs, including under-reporting of fees associated with investing indirectly through interposed vehicles. Accurate and consistent fee disclosure can also help ensure that there's fairer competition between product issuers in the market. So where did this start? We made some amendments to the corporations regulations. It's not actually where it started. It started a couple of years before this, but last November 2015, we published a revised version of our main guidance to industry in Reg Guide 97 and made some amendments to the corporations regulations through a class act at that time. The transition we provided at the time we thought was very generous through till February next year, so those new requirements come in February next year for product disclosure statements. We've been recently asked to extend that further. We did consider that very carefully, and we decided not to extend the transition period because we think that transition period is sufficiently long. But we are also very motivated by the fact that inconsistent and under-reporting of these fees does harm to investors, and that is not something that we want to allow to continue. We have been engaging, of course, with industry through the course of this transition period to answer questions to help with the implementation. Most recently, we've asked the industry associations a few weeks ago to provide us with a list of what they see as their key frequently asked questions. What are people like you asking them? And part of this process is to collect some of that sort of information together so that we can publish some frequently asked questions as well. And we do encourage you to contact us over the remainder of the transition period if you've got questions. But a common line of inquiry has been in relation to the inclusion of transaction costs in the indirect costs that need to be disclosed for super products. In particular, around unlisted assets. This is a topic that's come up quite a bit. Now, we recognise that this is a new requirement that was introduced, in fact, as part of the stronger super reforms that resulted from the Cooper Review. Now, there's some concern, and I think understandable concern, that this might make some products seem more expensive and perhaps also lead some trustees to avoid investing in assets that have high or lumpy transaction costs. Now, we understand that approaches to fee and cost disclosure can have implications for competition, but we think the key point here is that promoting transparency will reinforce trust. Or if you take the counterfactual, how does it reinforce trust, or how does it actually work in your members' best interests that you're not disclosing this to them if the fact is that investing in certain assets is more expensive? I'm not actually completely clear that it is more expensive when you think of some of these lumpy assets that you might be holding for some time over a period of time. It might be lumpy in a particular year, but we're all looking to get investors to think about the long term as well. But even if investing in a particular asset involves higher transaction costs, why is it a bad thing necessarily to hide that from your investors? It's something that I don't quite understand. The other thing that I think is important about this fee and cost disclosure work is that it provides a great opportunity for you as you're going through this process actually to engage with members about why it is that you've adopted a particular strategy and why it might be, or why it is, in your view, in the best interests of members to invest in a particular asset class. Notwithstanding that it's got higher costs, but obviously because it's got better long-term returns or fits much better with your overall investment strategy. After the transition period, I should also say, we expect to undertake compliance reviews to check how well issuers are complying with the disclosure requirements. Now, certainly, we are very keen that in the first few months of full implementation of this regime, we adopt what's called a facilitative compliance approach. This is not unknown for ASIC. We've done this with the introduction of a number of licensing and regulatory reforms over the years. And effectively what it means is that by all means, while we will be going out and checking and seeing how people are implementing the new requirements, where people are making a genuine effort to comply with the new requirements, but there might be some issue that they haven't been able to quite deal with, we will be taking a facilitative and educative approach. But obviously, if people have made no effort to actually comply with the approach, or worse, have done something that we think is deliberately misleading, then obviously we'll need to consider taking appropriate enforcement action. And finally, and very quickly, I just wanted to touch on another area of interest to us, and really do no more than touch on it, just draw it to your attention, which is around performance reporting by super trustees and responsible entities of managed investment products. And this is something, an objective, particularly for the APRA regulated funds, that obviously we share an interest with APRA. Fees and costs are important, but they're not the only element that should be considered by investors. Performance reporting obviously can drive investor decision making, and it very much, we understand how much it impacts on competition in the industry. So we're interested in exploring with industry whether the reporting to investors on performance is being calculated correctly and consistently across the industry. Our work in this area is in its early stages, and we'll certainly be discussing it more with you as that work progresses.